Okay, folks, welcome back. This is our midweek review for February 3rd, 2021. General commentary, dollar index, fiber or Euro USD, cable or pound versus dollar, and our daily log entry for fiber and cable. All right, so here's the economic calendar that's remaining for the week. Tomorrow's pretty heavy for cable, so just be mindful that we could potentially see some pretty wild volatility on British pound. And then we have Australian at 5:30 p.m. and 7:30 p.m. we have a policy statement for Australian dollar. Main focus tomorrow is sitting on your hands. Do not participate. This is non-farm payroll week. We have huge manipulation scenarios for tomorrow on cable. We'll talk a little bit about that when we get to that pair. But then obviously on Friday, we have Canadian dollar and dollar index based volatility injections for the New York session. All right, so let's get started with the breakdown. All right, daily dollar index. Pause your video if you're not ready. All right, so we finally got our way up into our weekly fair value gap, and volume imbalance has been traded into. I'm going to side with the potential that we'll still try to press a little bit deeper into that weekly fair value gap. This is enough, though, and had it not been non-farm payroll week, that would allow me to still be trading tomorrow and maybe even into Friday morning. But because it's non-farm payroll, and there's a great many of you that are new here, some of you are not going to listen. Some of you are going to be in here trading with live funds, and you're going to probably regret it. So as a reminder, non-farm payroll weeks, we look for our setups to form on Monday, Tuesday, and usually by Wednesday, 7 a.m., we're usually done. No new positions are to be taken or assumed in our demo account. Just study the rest of the week, okay? I promise you, while there may be trades that form beyond that parameter sporadically throughout the year, and you'll probably want to kick yourself for not being a participant in them, most of the time you will be thankful you follow this. I do this religiously. Like, I do not deviate from it. So it's up to you whether or not you want to learn from me and do it without pain, or you want the scars. And it's completely up to you. But why you would want to do it, I don't know. But here's the dealing range again, the high, the low. Midpoint is here, so this is equilibrium. So below this level or at it, it's discount when we're below. And if we trade at it or above it, we're at a premium. So I like the idea of getting up into the optimal trade entry, which is the lower level here and the upper level here. So that's optimal trade entry. Fair value gap levels are here and here, and this is again derived from the weekly chart. So we've hit two premium PD arrays, that being the volume imbalance here, and that's simply just an absence of any bodies in the candles that are connecting. It's just wicks and tails between this candle's close and this candle's open. All right, so that's one premium array it traded to, and then obviously the weekly fair value gap, the discount end of, or the low end of the two respective levels that make up a weekly fair value gap in our chart here. So we're going to study and see if there's any continuation on the upside. If it does, so what? If it doesn't and goes lower, so what? Now, you're not going to feel any regret. You're not going to feel any excitement. You're not going to feel any emotion whatsoever on Thursday's trading or Friday's trading, regardless. You want to be indifferent. You don't care what it's going to do. And this is what you want to do every single first week of the month where it has a non-farm payroll Friday. All right, moving into the 60-minute chart for the dollar index. Pause your video if you're not ready. All right, so here we have, again, the weekly fair value gap, the low end, the high end, and the optimal trade entry level here. We have buy side liquidity pool that's been engineered, and we have fair value gap. We dipped into that, and this is the premium level relative to that daily time frame in its respective dealing range I've outlined. Order block, we have a little bit of a sell side liquidity pool in here with a fair value gap, which is not being annotated. I'm trying not to draw any special attention to this because I don't want to entice you to do something tomorrow for those that are a little bit less likely to follow my instructions and want to adventure into dangerous waters. But one of the things I would like to see, if we do get some drop lower on the cable related news drivers tomorrow, because everything will be a mirror image in dollar, we could potentially see the sell side liquidity ran out in here on some wild, crazy spike. Institutional order flow entry drill could be a factor tomorrow here. And this is such a wild, just shot in the dark type thing. Okay. And it's not, I don't have any reason to frame it other than just wild volatility that may present itself. And if it goes down into here, that could be enough. If it drops down here first, then I would expect it to run the buy side liquidity pool. But if it runs up first and takes this liquidity out, then I would look for this potentially to reach for the sell side liquidity here. Okay, it may require Friday's trading to do that. Or nothing happens. There's just no real volatility that's injected in the market, which I find that a little hard to believe, but it's always a possibility. 15-minute time frame on the dollar index. Pause your video if you're not ready for the annotations. All right, so the buy side liquidity pool, again, as I mentioned on the hourly chart, and we have a small little fair value gap in here that might be useful going forward on both sides of the marketplace. We could come down here and pick up some orders and then pop up into the buy side liquidity pool, or if we trade down through it, come back up in, then reach into this area here. Okay, so it's a 50-50 either way, but I would venture to say that the buy side liquidity pool is more likely to be tagged first than this, only because I'm following with the momentum. But also add to the fact that because it's non-farm payroll, I'm not willing to take the trade. So that's the caveat to all this. I'm giving you logic. I'm giving you what I would expect to see in price, but it's not enough to take a trade on versus what I outlined in the weekend and what we saw transpire over the course of this week. All right, moving into euro dollar. This is the fiber daily chart. And if you're not ready for the annotations, pause your video. All right, so here's the lower fair value gap and the upper fair value gap that I outlined on the weekend. And I said I didn't care which one it ran for, but we wanted to use the opening gap on Sunday to determine which direction it's going to go towards. So basically what you learned a little bit is how I use Sunday's trading. Not that I trade Sundays anymore. I used to, but I don't trade Sundays anymore. And I've grown to be more comfortable and content with letting Sunday do its business, and then maybe even as much as Monday. And I know some of you hear that and say, oh, ICT never trades on Monday. And there's moves that I've taken out of the marketplace, or I've seen other people take trades. I can trade on Monday, but my interest lies more on the weekly range. So I can find all kinds of trades intraday, just like you have been learning how to do it as well, using a 1 and 5 minute chart for small little fair value gaps, institutional order flow, entry drills, runs to liquidity, runs to imbalance, rebalance. All of that is possible, yes. But I like to have a weekday to myself where I can do things. You know, I have to go to banks, I have to go to stores, I have a family I have to take care of. So I like to have a weekday where I can do those types of things. And usually everybody else is at work, not so much anymore because of everything that's going on with COVID. But the idea is I'm letting Monday do its thing, just like I let January do its thing for the entire first quarter of the year. I'm not in a hurry. I'm not in a rush. And that's the difference between new traders coming in and coming under my wing. They want to do something all the time. They want to do something really, really quick. And I don't care so much about trading on Monday. I don't care so much about trading on Sundays. I want to use those days for intel. Okay. And back to Sunday's opening. By using Sunday's opening price, if I am seeing an opening higher gap opening on Sunday, and I can see a premium array that may be a reason for it to trade up to or draw on liquidity, then it frames my bias. Then I look for supporting evidence in price action. Does every down close candle in the time frame I'm trading or monitoring, is the down close candle supporting price? So that means institutional order flow is bullish as long as bold up close candles, which would otherwise be bearish order blocks in theory, if they're being broken and short-term highs are being broken, that means we have institutional order flow that's bullish. So that's kind of like the quick and dirty way I like to look at the initial stages of the weekly range. Now you're going to learn a lot more, but that for now starts it. If we open relatively unchanged on Sunday, that to me, as I mentioned multiple times now, the idea that we're really not in a hurry to go anywhere, which is why I elect to use Monday. So, but if we get a lower gap opening on Sunday and we have a discount array, as I outlined, if we get a lower gap opening on Sunday, this is the one I said we would trade to. If we had a gap opening higher on Sunday, this is the one I said we would trade to. Now, that's not plan A, that's not plan B, that's algorithmic, okay? If I have a filter that says if Sunday's gap opening is higher, then I'm bullish and I'm going to look for it to trade here. If I'm seeing a gap lower opening on Sunday and I'm looking at a discount array like I've outlined on the weekend, before the market even opened up, you knew these things, then I'm bearish and I'm going to see this as my objective. Now, add into the fact that we are a non-farm payroll, okay? Because this is going to be a huge paradigm shift for a lot of you. And for many of you, your jaws are going to probably drop when you hear what I'm going to say. These are the details I've been priming you for, and now we've seen it, okay? Today is February 3rd, 2021. 7 o'clock in the morning, Wednesday, caps our week. We cannot take any new trades after that on non-farm payroll weeks. Think about what that means. That frames the likelihood of a market reversal profile or a seek and destroy scenario where the market just goes back and forth, up and down in short-term spikes that don't really go anywhere, or just a consolidation that just goes really quiet. What I just explained to you is what you're taught in the core content lessons. When you go through them, it's going to feel like this is so vague. This is so not exciting. It's not sexy. It's not, but this is where that boring stuff gets put right to work. And these are the things I said to you before it ever happened. Look at the daily chart here, okay? The order block, the fair value gap, sell side liquidity pool below this low here, okay? Here's today's trading, Wednesday, Tuesday, Monday. Monday, right from the jump street on the opening, slams heavily. We open here, trade back up in, and then sell off again. Same thing here, lower, and then finally closes in the fair value gap. Now, it doesn't need to go exactly to this level. If it would have just went to the midpoint, consequent encroachment, that would have been enough. I would have been saying, see, look how predictable it is. But look how much more nicer it is when it comes down just about to 99.9% of the range between the high and the low relative to this candle's low and this candle's high. That's your fair value gap. Specifically, buy side imbalance, sell side inefficiency. So what has to be delivered to balance this range out between this candle's high and this candle's low? A candle that's trading down. Well, we had that yesterday, didn't quite get down to the low end of it, and then we had another attempt to go down today. So what happens when it does a closure of the gap and we meet 7 o'clock in the morning on Wednesday? That means we're done for the week. We don't care if it goes lower, but it's most likely to consolidate and maybe even see some movement on the upside as a retracement, or altogether a reversal in some instances. Moving on to the 60-minute chart on Euro. If you're not ready, pause your video. All right, so here is our order block and mean threshold here. And we have a run up, small little imbalance that's filled here. All of this was discussed in the previous discussions and recordings. Small little fair value gap there. Trades up into it. Buy side liquidity pool. We run up in here, creating a breaker, which is a high, low, higher high. Last down close candle. Carry that out in the future. Sell side imbalance, buy side inefficiency. Fair value gap. Okay, but specifically it's sell side imbalance, buy side inefficiency. It remains open. They'll probably use that in the future. And here's the breaker. We trade up into it here. Small little optimal trade entry there. Sells off one more time. Fair value gap and optimal trade entry. High, low, multiple times, but kill zone related here. Not so much here. This was before midnight on the 2nd in New York time. This is specific to London Open, and that's where you get this really nice reaction here. Sell side imbalance, buy side inefficiency here as well, which is not annotated. Smaller retracement, dives in deeper, back up into the last up close candle, bearish order block, then sells off and attacks the sell side liquidity below this low here, and almost gets down to that low end of the fair value gap. In other words, the fair value gap discount low, and this is the fair value gap premium high. This is a range, a defined range, so we can refer to this level as a premium, and this is a discount. Okay, 15-minute time frame on euro dollar. Pause your video if you're not ready. All right, it's the breaker. Trade up into it here. Small little fair value gap as well, which is not annotated because I'm going to have some of this available for you, but I'll annotate what's not in the actual chart typed out for you. So optimal trade entry here with a fair value gap into a bearish order block, then sells off. Fair value gap in here with optimal trade entry, which is over here. And it dies below this low and this low here. Then we have this run up. Time sensitive around the London Open kill zone. Fair value gap remains open here. Sell side imbalance, buy side inefficiency. I got a question real quick. How I actually annotate. So I'm going to put a small little segment in Thursday's daily log entry video. So instead of like a 8-minute video, it might be about 15 minutes, legitimately 15 minutes. I'm being facetious. The last time I said on my community tab, we would have a very short video. But I'm going to show you how I do my annotations, okay? Because I had a couple members ask specifically how I do it and how I'm adding it and what fonts I'm using and stuff like that. I don't know that I can change the font on TradingView. I just use what's available, and you'll see it's not a whole lot to it. But I did this here, and the way I do this is simply using a trend line. So I draw a small little segment of a trend line here, and then I add the annotation below center in the alignment for it. And because I'm having the trend line like this, small little trend line vertically illustrating a parallel line to this drop down, if I make the line white like my background, you don't see that level, and also fade it out to the gradient of translucent. I don't want to see the line at all. Otherwise you'll see little ghost images over top of the lines I do have. And that's how I use to create these vertical annotations. So for SIBI and BISI, I want to use vertical orientations, and fair value gaps I'll use horizontal like this. So they're both the same thing. They're in balance in nature, but by category and classification, it helps you learn, because if you look at this state of social media right now and people thinking they know what I'm doing, they have things on their charts that are erroneously annotated, and it's annoying to me and it's offensive to me because they're not really my students. They're just people that are getting hand-me-downs, and that's the part that drives me nuts. And I was watching a podcast from somebody that supposedly was a student of mine, or reports that he was, and just not doing too well on a demo account challenge or trade simulator thing, and it's being billed as something ICT. And when people see that kind of stuff and they don't see what I actually do here, it's really irritating to me, because that's the type of stuff that I used to rise up on in YouTube and go crazy, go after people. But you all in here get to see the refined ICT. Okay, you get to see what it's like to work with me on a professional level, and you also see what it looks like when I'm showing you what's going to happen before it happens. I understand my name's a draw. It draws a crowd, and I'm in demand, and I want to try to like diminish that and not be so much of a reason for people to put my logo on their stuff just to draw attention to themselves. And when the attention is on them, they fail miserably. And by default, they think, well, see, that's proof that ICT doesn't teach anything that works. When you all here collectively are witnesses to it. So that's what I meant when you first came in here. Don't judge me on a day by day. Judge me over months. Okay? And you're going to see that there's more consistency and more accuracy than there are the short little times where I'm not right. And that's going to happen. That's fine. But it isn't a lot. And then you contrast that with other people that try to say they understand this stuff and they can't even come close. And you're going to be way better than all of them because you're genuinely here learning the right way, not getting pieces of something that was shared or hearing something that's been rephrased by someone else that's trying to talk like me. So anyway, the fair value gap here is open still. Sell side imbalance, buy side efficiency. Came back up in. Didn't quite get the consequent encroachment. This is institutional order flow entry drill. It needs only just traded this candle's high. So if you would have used that as an entry to get continuation lower, you would have had a little bit of heat on that. Not much, less than 10 pips drawdown. Now, if those types of trades with that much drawdown, which when I say that much, it's really not a lot. But if that bothers you, if that's a worrisome thing for you to have 10 pips in drawdown, you need to get used to that. Because in the beginning, you're probably going to have 20 pips drawdown, 15 pips drawdown. You may even get stopped out a lot, and that's normal. When you're looking at things and you're pretending that you would be in a trade right now by observing, you're paper trading but not taking it in a demo. You're going to see times where you're wrong, and you need to be mindful of how much time that you're hypothetically saying that the market's lower and you're going short. How many candles? How much time? What's the duration that trade had to endure before it covered the dealing spread and moved to profitability? Those are the things that you need to be recording in your study journal. Not how many pips I made. Okay? Not just how much drawdown you had. How much time you spent in drawdown versus how much time the trade was in profit. Because it's beneficial information because you need to desensitize yourself from looking at a chart that's static. In hindsight, it's altogether something different when you put yourself in a trade. And while you're in these trades, if the trades don't pan out right away, that's an uncomfortable thing. So what you want to do is get a collection of all of your trades for the week, or not specifically your trades, but demo trades. Like when you're watching them, observing them with a paper trade idea, both instances, you want to record how much time the market spends in drawdown from your idea. And then what you want to do is you want to get an average of all of those executions or hypothetical executions on the week and on the month. And then what you'll do is you'll start seeing how much your average length of time, it may be in minutes, it may be longer, how much time your trades stay in this negative state where it's under the dealing spread. So it's beneficial because it will condition you not to anticipate immediate response, because there's some trades that you're going to get into that just meander around a little bit, and that's nothing wrong about that. There's going to be trades, I take trades like that, and it just doesn't always run away as soon as I get in there. But you need to submit to some measure of time. That again, right? You need to know that it's normal for you to stay in a trade for a certain period of time. Now, what benefit do you get from having this intel? By collecting this data, what does it give you? Well, what happens is if your average length of time in drawdown is, say, 20 minutes or less, and then now you're in a trade that you're wondering, man, does this thing look like it wants to move or not? But now it's 45 minutes. Is that a trade that you're going to most likely win on? Probably not. But even if it does turn and go in your right direction after you bail on the trade, it frees up mental capital. You do not want to tie up mental capital. You're stuck with whatever amount of money you have in your account. That's it, unless you add more. Most people don't do that. Okay, they want to grow it with the house money. But if you get into these trades and you start seeing these characteristics that are uncharacteristic, of what your model delivers and your aptitude as a trader. If 20 minutes is the average across the month, which you see generally, and you're in this trade and you're starting to wonder whether or not it's going to go in your favor, and it's 45 minutes in, you're still under the spread. If you haven't overcome the dealer spread, then in my estimation, that's probably a good thing to do, is by bailing out on that trade and just taking whatever minor loss that is. Save your stop, free up mental capital, give yourself some time, and go back in the next day looking for another opportunity. But you don't see people teaching these things. And this is what institutional trading is. It limits the exposure rate to losing. That's why you have to have rules, just like I'm teaching you here, and everybody else that's underneath my tutelage in this mentorship knows this as well. We didn't just create the idea of stopping trading on the week that non-farm payroll comes out at Wednesday at 7 a.m. New York time. I didn't just create that rule. We've been operating in that rule since I started teaching it. So if you don't learn from having no pain and only the pleasure of being preserved from going through that trauma of doing things that I tell you not to do just for the sake of doing it and getting us the car, you're doing it wrong. Okay, you're doing it wrong if you want to engage and have that pain. If I could go back in time, I would elect to use the mode of training that you're doing. I would rather have that, because if you have these barriers and pain that I still sometimes will get into a trade and something will jog my memory about another instance where this happened or that happened, and it's not the trade itself that I'm doubting, it's myself. Okay, I'm not doubting the system, the method, or the methodology. I sometimes doubt myself, and the way I beat that is I turn the charts off. My stop's there to do its job. I'm paying that stop loss to do its job. I don't need to worry about that price getting hit because I'm paying the stop loss to do that job. What I manage is, does the trade still work out in my direction? So if I'm apprehensive with staying in front of the chart and I'm thinking about something that happened in the past, I need to defeat that negative thought. And the way I do it is I turn off the charts and I go work out. I go do sword drawing, drawing with a sword. I do a walk with the dogs. I'll take a drive. I'll go spend time with my wife. My kids are homeschooled, so I'll check in with them, see what they're doing. But I'm not looking at the chart. So these are things that you want to be building in to your development. And while you're observing ideas and studying price action, these are critical things that you want to be logging, and you want to start doing it early, because it's not something you're going to want to do later on, because you're going to be fascinated with other things that you learn in the mentorship. But if you start ingraining that habit now, when you're looking at price, or if you look at a price action move, if it's something quick and dirty and you're looking at a chart and say, oh yeah, this is a pair I don't usually see or worry about, and say it's the New Zealand dollar, and you go in there and you start looking at an hourly chart and you see a setup, just for experience, from where you would think the stop would be and your entry would be, how much time did it spend before it overcame the dealer spread and moved into profitability? And then how much time did it take to get to your target? Now, obviously you have the benefit of hindsight, but these are things that you can start doing right now. And you're going to see that the things that you're learning over the months going forward, you're going to see that these things shorten the amount of time that you're in drawdown. And then over time, you'll have less drawdown. You're not going to have zero drawdown. Okay, that's not going to happen. You're not promised that. You're going to have losing trades. You're going to get in a trade, and as soon as you get into a trade, it's going to go right to your stop loss. And guess what? That's normal. It's called a mistake. Okay, you're going to file that away in the category of being human. Okay, I have that chapter in my book. I'm still living it. I wish it wasn't as thick as it is. There's a lot of instances where I've been human over the last 3 decades almost, but you're going to have these instances too, and give yourself permission to endure them and use them as experiences to draw learning from. Don't try to resist them. Find out where the flaws are so you can fix that thought process around them. And one of the most critical things you can do in your development is log how much time the markets spend in adversity once you're in a hypothetical entry. I promise you, if you don't consider this right now, it will be a factor when you start demoing, and it will absolutely be a factor when you put your live trades on. If you ever decide to do that, you will feel this. You will feel it. And if you don't have some baseline measurement of what it is typically the amount of time that you spend in a trade in drawdown, then you're going to be worrying, aren't you? You may not think you are. You may be shaking your head, I ain't got to worry. You will. Trust me, you'll worry. And you'll be wanting to close the trade as soon as it gets in 10 pips profit because it's drained you. Whereas if you are in a trade and your average is 25 to 30 minutes drawdown before your trades start to move in your favor, and I'm not going to give you a high end, low end, because if I do that, that's doing a disservice because all of you are going to have your own unique models. But to me, I don't want to be in a trade in drawdown for an hour. That's just me, okay? I'm not going to give you a time for me, and I'm not going to share that with you because, again, that creates a baseline that you try to strive for when you may find a sweet spot that you're comfortable with that's less than an hour but more than 10 minutes, okay? So it's hard for me as a mentor to be fair to you and not stifle your own personal development. So I'm giving you, yes, I like to see less than 1 hour. And no, I'm not going to give you the low end objective where it's the low end and here's the high end for me. So I'm not being mean to you. I'm not being selfish by not telling you that. I'm helping you not use that as a way of measuring your own because you're new and it's unreasonable. And it's something that humans do, especially the young men. They think they have to measure up, or if they can't, they feel self-defeating. And I know I went off on a tangent here. But this is meaningful stuff, and I got inspired to answer this question in an email I got a couple weeks ago. And I just got to it. But the idea of, what can you do to help increase your learning while you're doing it? These are the things you do. But if you have these trades on, and you have a trade that runs less than half the amount of time that you have as a large end or high end time limit of drawdown, say we'll use 20 minutes as your drawdown. Okay, that's the average length of time that your trades as a whole collectively is 20 minutes, or the average length of time that your trades stay in drawdown before it moves to profitability. But then you enter a trade and in 5 minutes it starts running for you. Is it going to be easy for you to hold that trade? Yes. Is it going to be because it's running fast in your favor? Maybe, but more so because it's way under your average length of time in drawdown. System development doesn't ever really consider that, but analysts and quants do. And my background forces these measurements in my perspective, and that's one of the things that's driving me all the time since I was a young man to be precision oriented. And I have to have a way of measuring precision. It can't just be, oh, you got it in the right price. Okay, how much time did it spend above that price when I was short? Because it might run 200 pips in my favor, but if it spent 2 hours and a half in drawdown, I don't think that is a good trade. I need to improve on that. Where is the flaw that I need to improve upon? That's how my mind thinks, okay? And I'm trying to subtly change your thought process from, I need to know my entries, I need to know, what direction the bias is. You're learning all that, okay? You learned a huge amount just this week, and you saw fruits of it after the fact. You were told beforehand, and now you see it, okay? Was I perfectly delivered to the low level here? No, look at that. It failed. That to me is a failure of perfection. But are you going to wrestle with just this much of a deviation from the expected low? And this is all that the market actually printed. Now, if this is what you're going to struggle over, let me remind you that every broker is different. The low that was created on this very candle here, if you go across TradingView and put in the individual different brokers that are available for Eurodollar, you're going to see that candle has a different low than the other brokers too. In other words, there's going to be a difference or deviation in their printed low on that candle. Some brokers might have got down that low, maybe one pipette below it, and others it may not have went down as far as this one did. That's normal. I get emails all the time. your chart doesn't look like my chart, or this doesn't look like that. And why don't you use this or that? I use what I use, then I show you in the chart. No, I don't use anything else. Okay. You're seeing what I'm observing. That's it. So to question why I don't do this and I don't, it's the shorter answer and the shorter focus point is just use what I'm showing you. There's no reason for me to spend time justifying why this and why that. Just go with this. There's no real necessity to know why, except for this is what I personally like to use. And you came here to learn from me and what I use, so I'm showing you. But I don't think we need to have a podcast to do why I do this chart versus this broker. And it's not because I'm trying to sell the idea of Forex.com. I just trust that feed, okay? And I'll just say that, all right? But anyway, the market trades up into a small little fair value gap in here, institutional order flow, and then finally makes a lower low. So we have a sell side liquidity pool here, a lower one here, digs into it here, and then ultimately rolls deeper into the third here. Now, this isn't a whole lot of action on Wednesday's trading. Think about that. Think about what I mentioned about this week. It's non-farm payroll. So if non-farm payroll weeks, we want to be out of the market around 7 a.m., no new trades after 7 a.m., then there needs to be things that you look for in price action to support that viewpoint. Because unless you see it and you log it and you pay attention to it, you're not going to remember not to trade. You're going to want to trade, but you have to have rules. Just like when you drive, that yellow line in the center that separates the oncoming traffic and you, that line isn't there for decoration. Okay? It's not a suggestion. It is an absolute definitive line that if you cross this, when there's another car coming, there's probably going to be a result that you're not going to favor. It's going to be uncomfortable. Probably so much that it'll allow you to check out. So these are rules. You submit to them all the time. Now, we don't like to submit to the speed limit, and that's what happens when you are a student. You want to press the pedal to the floor and go faster. You want to get through those uncomfortable, like this discussion right here. You want to get through these periods and get to the things that you think is important. But as a student, you don't know what is important yet. As the teacher, I do. And I'm pressing you in the periods where the more valuable lessons are needed when they're needed. And then when you get to the easy stuff, that stuff that you want to make a big deal over right now, it'll be more meaningful to you and you'll be more versed. Meaning, if I give you a sharp blade and you've never held a sharp blade in your life, or if you give it to a child, okay? I don't suggest you do this, but if you give a knife, a blade, a live edge to a child, what's the first thing they're going to reach for or touch? the point or the sharp edge, the part that's going to hurt them. It's just like that analogy I used many times in the past. If you walk around the neighborhood and the neighborhood is a high-end neighborhood and you'll see signs that say, don't walk on the grass. What's the first impulse you want to do? Who's this guy thinking, telling me not to walk on grass? You inside, the child in you, and believe me, I wrestle with it all the time too, because I don't like being told what to do. Like when people tell me don't talk so much in the videos, it makes me want to talk more. If I see signs like don't do this, okay, well, I want to, in my mind, I'm thinking, I'm going to walk all over that. It's human nature. We want to do the things we're not supposed to do. It's in us, okay? When we get in our cars, we see those signs that say, don't drive more than 65. Don't go faster than 55. Well, like you, I have the tendency to want to go over that. And I have paid the price several times doing it. And if I would have just listened to that posted speed limit, I would have never ended up in a situation in accidents and causing accidents, because I have caused them when I was a younger man. I did those things because I didn't follow the rules. Non-farm payroll that week is absolutely requiring you to follow these rules, because if you don't do this, you will lose money. You will absolutely lose money. Now, why is this beneficial? Why is it beneficial for you to know where and when you're likely to lose money? Well, it's pretty obvious, isn't it? But nobody writes books about that. Nobody makes courses about that. No one puts chapters in books like that because they don't want to give you the impression that you're probably going to lose money, because that doesn't make the sale of the book feel like a good purchase. Then you're giving them the full picture. And I'm telling you, if you ever take a live trade, you're going to lose money eventually. And you're probably going to lose more than you're willing to lose right now, both in money and the frequency. But that's part of learning how to trade consistently with longevity and continuity. You can't be consistently profitable until you go through periods of unprofitability. So it makes perfect sense. It's reasonable. It is wise for you to learn how to do this in an environment that's not going to hurt you financially, and it's not going to hurt you psychologically. If you lose in a paper trade, does it really take anything away from you? No. It might be frustrating. You want it to be in your favor. But if it isn't, well then, so what? You're learning. It's justified from where you are in your terms of development. But if there's rules around this particular week, let's look at see what happens on the 5-minute chart. All right, so here's the 5-minute chart on euro dollar. If you're not ready, pause the video. All right, so here's Wednesday, February 3rd, 2021. And we have a fair value gap in here after buy-side liquidity has been taken midnight in the Wednesday hour of New York time. Fair value gap, initial little run up, trades back up into the fair value gap here. There's a small little fair value gap as well, trades there. Sells off, imbalance. We create a fair value gap and the order block combination right there. Well, that right there, when you're bearish, what are we looking for? We're looking for this fair value gap to close in. Okay, that's what we're looking for. Or it could be just the consequent encroaching midpoint of the gap, and that will be enough for you to take partial profits too. But you have to wait until London open, kill zone. Here's 2 o'clock in the morning. So while you have the signature here, and it has a trade up into that, and it does sell off here, it's better to wait for it to try to drive up into that in London open. So we have optimal trade entry here, and we have another smaller one here. So you can find this one on a 1-minute chart for your own study. Then it sells off, it creates a fair value gap in here, deep dive beyond consequent encroaching midpoint of the gap high and low, trades back up into London open kill zone. So we have a optimal trade entry here as well. And then a smaller one here on a 1-minute chart, you could have done that as well with a breaker. So lots of things happening in here. We have time, and we have a sell side liquidity pool here. So you can be short here or here. Ride this. Don't jam your stop loss. Okay, keep your stop loss where it is in London while you're developing. When you get to the lessons that teach stop loss management, then you can do things differently. But whenever you take a trade idea, whatever your initial stop loss is, don't move it. You need to be focusing on, does price go where you want it to go while you're in the idea or in the demo trade? If it doesn't and it takes your stop loss out, you need to feel that, because you're going to learn a skill set later on in this mentorship that helps you manage that stop loss, and you won't take full stops. In other words, you'll be able to take a smaller loss, and it'll feel much more monumental when you get to that point. Whereas if I teach you how to move a stop loss now, you won't manage it correctly, because you need to know other things to help frame out the trade. And it doesn't make sense what I just said right now because it's the first time you heard it. Make a note of what I just said in your journal for month 1. Okay, month 1, I'm going to learn stop loss management eventually. But for right now, all paper trade ideas or demo account trades, and the initial stop loss stays where it is until I learn stop loss management later in the content. Okay, and you're months away from that, because it's not important right now. Just know that this is for your best development. You're going to learn the proper way by doing it this way. It's going to teach you to respect the risk. If you open the idea up of a trade and whatever that stop loss is initially, technically that should be the best position to have your stop the entire time of the trade, right? Because you're saying that that's where you're wrong. What started the trade, that level is where you're wrong. So every moment that's below that, if you're short, are you still correct in your eye? Sure, the trade's still valid. What gets you in trouble is you want to hurry up and move that stop loss. Again, that's why large fund traders don't jam their stop loss. They look at the market, they say, okay, this is where the stop loss is. Initially, it opens up the trade here, and there it is. Most of the time, they're very rarely moving their stop, which is why I teach you these liquidity runs. That's not just retail. Large fund traders trade with the same concept of stop loss placement. But these authors over the years have been coming up with this trail the stop loss, 10 pips, 15 pips, using automated stop loss trailing EA. All that stuff is garbage. It's absolute garbage. You need to use what I teach in stop loss management because, number one, it's going to be the most efficient way of doing it, and it's specific to the criteria for each individual trade, period. It's scalable because of the trade you're framing, but the logic is the same. It doesn't shift around. It doesn't change. It's not dynamic. It's the same thing you do in every single trade, but every single trade is going to be different in terms of what your entry is, where your stop loss is, and what you're standing to make in that respective trade. So I can go on a lot of different rabbit trails on this one, but I'm going to take the focus back to this because we still have cable to go through. But London Open, optimal trade entries, multiples in here, institutional order flow at the fair value gap. And it trades down, but doesn't take out the short-term sell-side liquidity pool. It trades back up into this small little, and you'll remember seeing this before in other discussions if you've been here for a while. If there is a wick or tail, like we have right here, okay, small little body candle and all of this wick that runs a short-term high, if I see this, I take that entire candle out, or at least the wick or tail, I take that out of the discussion. In other words, I ignore all this price action here, and I'm focusing just primarily on that body of the candle, okay? And then if I do that, what I end up seeing is we have this candle's low and this candle's high, and this big wick doesn't exist. So what would be residing there? A fair value gap. Whoa, that's pretty cool, isn't it? I'm teaching you how to ignore certain things in price action that would otherwise trip people up. This is still an imbalance because this was a gap to liquidity. So take that out. That's manipulation. We don't need it to frame the logic that happens from this order block low and this candle's high. And look what happens right here. Perfect. Optimal trade entry. Sells off. When is it happening? What time of day is it? It's between the kill zones of London Open and New York Open. So this is something that you would simply manage the trade based on this reaction here. In other words, this was in your chart from the time it creates itself. And as it starts to retrace, my eye would be right here and saying, okay, I'm in the trade, but I'm not taking a new trade. So I would manage my position with the expectation that my stop loss needs to be above this. And if it goes up to here, that's fine. It should react there. Remember all the videos I would put on my YouTube channel and on Twitter when I had a Twitter account? And I would be showing you sped up recordings of me taking trades and annotations, talking about, okay, the market's going to go here, now it's going to sell off. Well, these are the types of things I was looking at in price. Not all of them, obviously, but this is just one of them, where you can anticipate the reaction here and trust that it's going to start to go down. Now, here's where we go into the importance of knowing the characteristics of this week. Every non-farm payroll week. 7 o'clock in the morning is annotated on the chart. Why? Because after that, you can't take any more trades. But you can study the likelihood of market reversal profiles. That means potentially reversing, or the likelihood of going into a consolidation or seek and destroy. Seek and destroy is when you'll know it when you're in it, where you get in there and you buy it and it goes down, takes your stop loss. And you think, okay, well, I was wrong. Let me go in here and sell short. And then you sell short and it runs up and takes your stop loss. And you're like, oh man, I'm ticked off now. I'm going to get even. So you buy it now, thinking it's going to keep going up, and then it goes down and stops you out. And you do this probably about 6 more times. I've done that before. I've done 30 trades one time trading the S&P back in the 90s. I got so ticked off and I got destroyed. Okay, I did it to myself. Nobody's fault but my own. I got mad and I was caught in that type of environment. And I was using a 5-minute chart. And then I got mad and went down to a 1-minute chart because I thought that was going to fix it. And all it did was give me more opportunities to trade and lose money. That will happen to you eventually if you allow it, but you need to have a number of trades that you're willing to take, and also have parameters when you don't take more trades. In non-farm payroll, we have a very specific protocol that we follow. At 7 o'clock in the morning on Wednesday, no new trades, but you can observe. What are you observing? How does it trade after 7 o'clock? Yes, we have a little short-term pop here, trades back down, rallies, and it trades into this fair value gap again, and then sells off and takes out the sell side liquidity pool here. Does that occur in the New York open kill zone? No. So does it make sense logically to take that trade? No. Why? Why does it mean it's not logical for me or you to take this short here? Well, the context. This week is non-farm payroll. That means Friday on the economic calendar, the unemployment numbers for the U.S. are going to be released. So if that's the case, then we have no business expecting this big dynamic price action move. And we have a rule at 7 o'clock in the morning on Wednesday, we have to take no new positions. We can manage open positions, but 80% of the trade needs to be closed. And for some, that's going to probably be, I can't do that. Why? You can't succeed? Is that what you're saying? You don't want to succeed. You don't want to listen to rules because these rules are going to work in your favor if you follow them. Are you going to lose opportunities sometimes? Yeah. But are you going to lose money if you don't follow them? Absolutely. You're going to see things that you think you see, and they're not there because the algorithm goes into a different state of delivery, and it becomes highly unpredictable. Now, I'm Inner Circle Trader. I'm ICT. I am Mr. Everything when it comes to Forex, okay? I mean, I will tell you what I'm very good at. I have no problem telling you that. But I also will tell you, in all honesty, where my weaknesses are and where you're going to struggle with IPTA. Because it does things that I don't understand during these days. Now, sometimes I can see, and sometimes I've presented trades where it's happened. But it's just simply me showing off, and it was working in my favor at that time, okay? If I did it as a steady diet every single month of the year, I would have more losing trades that month than if I just simply followed what I'm teaching you. So, is it beneficial to you? I would hope, as a student of mine here, that you would say, yeah, this makes sense. I'm going to just stick to this. But I know human nature being what it is, you're going to not want to listen. You want to walk on the grass. You want to go faster than the speed limit says. Doing those things have consequences, and they're your own. So don't blame me if you don't get the results that you thought you were going to get. But be content with operating in this, because if you study it, you'll see there's logic. But you won't appreciate or understand what that logic is preventing in terms of harm to yourself until you have more information, more content, and at charter level. You'll be able to look back and say, man, this is exactly what I should have been knowing all this time, but I was too worried about order blocks and when to buy the wick, when to buy the body. I mean, everybody comes in with that idea, and it's just a small little piece. It's just a small little tiny thing. There's other things you need to be worried about. And I mean worried, because if you don't learn these skill sets early on and create a habit with them, you're going to burn out. You're going to do things in the marketplace that's going to blow your account, and you're going to assume that you'll never be able to be profitable. When if you just follow the rules, you have a better chance of being successful doing it this way than you do having it your way. All right, let's go to pound dollar. All right, if you're not ready, pause your video. All right, this is going to be really brief. All right, so I'm looking at this line here. This is what I teach as a trend line phantom. I mentioned one other earlier, and I think if I'm not mistaken, I had it like from here to here, and we went down almost to that. Didn't quite get to it, I don't think, but my eye is here. Okay, so if we do continuously move higher on dollar, it might not. But tomorrow we could see a large range day, either side on cable, which is another reason why Just observe. But if we go lower, okay, let's just play devil's advocate and say we get a higher price run in the dollar index. And that means we should see a lower price in cable. I'm thinking right below here. That to me is the liquidity that would be juicy enough for them to tag into. And here's the other thing. It could go down there just to upset anyone that's long and then reverse to go higher. This pair has so much manipulation in it right now. I mean, just look at this price. This is a mess, okay? And again, you're probably saying, stop talking about ICT. Go to a fast market. Go to a real easy market. No. You need to see in contrast when these markets are in these states where it's difficult, because then you won't want to push something hard in these pairs. You'll be like, let me just leave that one alone for right now. Okay. Because to me, this is a rattlesnake. Okay. It's rattling, it's letting me know, ICT, you may think you're all that, but mess with me. Okay. Step close enough and I'm going to bite you. Okay. I know it's going to do this to me. I know it. My experience has taught me this. The fact that I see what I see in the price and the things I'm illustrating, it does not matter if I tell you something and it happens. I am not trying to trade this pair. I said that we would be focusing on euro dollar. And I think if you compare and contrast the two pairs, euro versus the dollar and pound versus the dollar, you would quickly run away with the idea that euro has been a lot better to trade and it's cleaner in its price. It means everything is much more pure in the candles formations, where it's reaching for. It's just easy, easy, easy. Clearly, I mean, I outlined the week before it even started. This here, whatever's going to happen is going to happen, and I don't want to touch it. And when you hear me talk like as a new student, it registers in your brain as, well, is this really ICT? Because I would expect ICT to be able to say this, and there it is. No. You need to know where it's likely to hurt you. And if by learning these skill sets and you don't have as much drawdown, you don't have as many losses, doesn't that increase the likelihood of you being successful? I mean, by default, it already, regardless of how much your winning average trade is, if by having a ability to identify clearly with reasons that you can feel comfortable with why you're not going to take a trade in this particular pair or this asset class, by having that understanding, that is experience that you cannot find in books. You can't. I didn't get it from any books. I didn't get it from any mentor. I learned this by losing fortunes, really losing lots of money and not having a good time doing it. Okay. It was very uncomfortable. It was very shameful. And it was usually after the days where I felt like I was on top of the world. And it just made better sense for me to go in and figure out what I was doing wrong. And that's what I'm teaching you. I'm teaching you that this pair has been showing all kinds of things that you don't want to see in price. And even though we've called it higher, I don't care. That is not enough to be in here trading cable. I got an email from, I don't remember who the person was. And basically, short and sweet was, cable's offering up really good trading opportunities right now. Easy. Okay. If that's how you feel about it, I don't want to touch this pair because I think that it can do something very, very tricky. And I don't want to be a part of it. We have Brexit still looming. We have all the shutdowns you guys are going through over there in UK. It's just a lot of things. And forget all that. If you just see the price action here, this thing's not clean. It's just a lot of tight little squeezes. And I think tomorrow we're going to probably see a big large range day on the downside. It may not close down, but we might see a big range expansion on the downside. Is that something for you to go in there and trade? No. Please don't do that, because I could be wrong. In fact, I'm probably wrong. Okay? I'm probably wrong. Because if I really felt that I knew what I was going to do, why wouldn't I be in there trading it? Right. I was confident enough to tell you what I thought was going to happen in euro, but I don't know what I'm expecting to see tomorrow in cable. Not with a great deal of certainty that I had on the weekend with euro. I knew what I was looking for. I have no idea what I'm looking for here. Not in this pair. Okay, so listen to what I've said here and really, really absorb the level of risk that I've just outlined. Because if you think tomorrow has a big opportunity for a big range and you think you're going to have a windfall victory, please don't do that. Paper trade it. Don't even demo it. And if you win, then call it luck, because that's what it really is. It's just circumstances that lined up in your favor, period. It's not skill, because this pair doesn't have anything going for it right now except for danger. Okay. All right, so moving on to hourly chart, let's get this over with. You can see we've been range bound in this. A lot of just messy price action, but just stop hunts is all it is. Stop hunts back to the middle of the range. Stop hunts back to the middle of the range. So if you're not ready for the annotations, pause your video. All right, so here we have a buy side liquidity pool resting. So should we get an expansion on the upside with some kind of news driver tomorrow that would be the catalyst for that? This is where I would expect it to run to. And on the downside, I already outlined where I felt it would go relative to the daily chart and its phantom trend line. That's what's being indicated here. So it gives you a little bit of bearing in terms of the price action, where we are in relationship to that daily trend line. I don't trade on trend lines. In case you're looking at that thinking, wait a minute, why is there a trend line here? Trend line phantom is just the idea that other traders see it as support, and I don't see that. Okay, I don't use that. I just look at where the stops are relative to that trend line, and I think the market's going to draw to that for the liquidity purpose. All right, so we have a rejection block in here. Why am I picking this one? Why not that one? Well, we have this high that was ran here, so we go back to this as a rejection block. This high here is rated here, and then this one's rated there. So what starts the chain of events? This high. That's the rejection block I'm looking at. But it went a little bit higher, Michael. It's not real perfect. Right, I don't care. I'm looking at, does it go above it and then pull away? Because then once it pulls away, then you can use that information of that rejection block. Okay, so in here we have the last up close candle, which is a bearish order block. Inside this candle, you could look for areas in here to be a short seller, or if you want to be selling on a momentum, you could put a stop order once it's trading up here. You can't be in front of the charts. Okay, no problem. Put a stop order to sell on a stop if it goes that below there. And right here, you can see it's beautiful, beautiful delivery. You don't need to be trading on limits. I teach you how to use stop orders too. And stops and limits are ways for you to trade. If you cannot be a day trader, or if you can't use these intraday ideas, you can look at a 4-hour chart and a daily chart and frame out a trade and not be up all night in London, not be up in front of the charts in New York, none of that stuff. The orders will do your work for you, but you have to learn a lot of things, okay? And it requires even more submission to time to trade like that. But it's possible. I do teach it. It's all part of it. But the way you understand how to do it consistently is studying these lower time frames, because it's the same thing on these little charts here, these intraday. The same thing happens on the 4-hour and the daily and the weekly and the monthly. It just takes longer time for these durations to pan out. But the same logic exists there, okay? So the market ends up breaking below this low here. We have a breaker and small little fair value gap here. I thought that was interesting, where you can see it trade up into that and then one more time into the order block and pumps it up into the breaker. Now, when you have a wick or a tail go beyond a breaker, as long as the candle corrects, again, I don't care about that. That's reasonable. It's expected. And I'm not going to make a big deal of that. And it's something that if I was taking a trade, this would not be a factor for me. I would not be nervous in the trade. I would not be thinking I'm going to get stopped out. You always anticipate, because of the broker's feed, your level, just like I was mentioning with the euro dollar, it just fell short, much in the same way it failed to get down to this very low here, right there. This is even bigger of a gap that euro offered before it got down to the low end of its fair value gap. So this is a bigger gap than euro when it was trying to make its low. But it's still offering the ability to get paid. Okay, so don't lose sight of that. But if we know that there's liquidity under here, liquidity under here, and here, we've already done a raid above this high here, and this high was rated here. So this whole pattern here with 3 higher highs, I learned in the Street Smarts book by Linda Rasch and Larry Connors. It's a small little short-term pattern that, to me, it's basically the 3 drives pattern, but they call it 3 Indians. Cute little name. I didn't like to talk about it too much because of the name, because I was used to being a young man that was, bravado, macho, and 3 little Indians didn't sound right. It should have been like 3 barbarians, 3 snipers, 3 one-shot, 1 kills, that something action oriented. Arnold Schwarzenegger, 3 daggers to the temple, something along the lines like that. And the women in here are probably thinking like, what are you talking about, ICT? The men in here get what I just said. But the pattern is 3 Indians. Okay. I didn't teach it as my own. It's something I picked up, but it taught, again, more premise around stop runs. The book came out in 1995, and that's about when I started picking up my understanding about price action that was apart from retail. Great little book. If you can get your hands on it, get it. So the same pattern here is the same pattern we have here. 1, 2, 3. 1, 2, 3. Okay. So it's three little Indians or 3 drives pattern. So it's driving up 1, 2, 3 times, and if it breaks, it's probably going to go lower as a short-term reversal, or maybe even a long-term reversal. So the point in saying all this is we have highs being probed for buy-side liquidity, and then the market reacts and goes lower. Goes up one more time, higher, and then breaks. Okay. What has it done more of? Taken buy-side liquidity or sell-side liquidity? In my opinion, if you look at, this price level, all of these here, it's done more work on the buy side because everybody wants to sell short cable. They really do. They want to sell short cable. But this pair has been torturing the bears. Every time they want to assume a position in this pair, they find a way to sneak it up higher and knock out the liquidity. And me personally, I think they have been doing all of this ahead of the interest rate announcement tomorrow. Okay, so that's why I'm electing to say that we're probably going to see a large range day on the downside for cable. But again, reminding you, please don't take this as gospel and that you should go out there and trade tomorrow. Okay, I'm probably going to be wrong, and in fact, if I'm wrong, good. It'll be a testimony as to why I trade this week the way I do. I don't want to assume a trade after Wednesday at 7 a.m. If I'm wrong, then who cares? No harm, no foul. It feels good to know I didn't trade, and if I would have lost. But some of you don't like to see that. You don't want to feel that. You want to be right, and never wrong. Okay? You never want to get stopped out. You never want to have any drawdown. You want to get in at the perfect entry, and you want to get there just like that. That's unrealistic. That's unreasonable, and no trader trades like that. Not even me. Not even on my best days. I'm never like that. Okay? But there are periods when I can be really on it. And the only way I can be like that is by identifying the things I'm teaching you here tonight. By understanding this week protocol. Okay, the first week of the month, non-farm payroll Friday, every single week like that, we trade with 7 o'clock in the morning on Wednesday. That's it. You can have 80% of your trade taken off and manage a small little portion because we don't know. ICT don't know. Nobody knows what's going to happen on Thursday's trading and going into non-farm payroll. Nobody does. Nobody does. Okay. If it was a way for me to do it, I would have taught it to you. I would be teaching it. There is no secret charter lesson that's going to crack this. I don't have it. Okay. So it's a way for me to build in support for me not to blow it because I've blown accounts on the first week of months when I was a younger man. I did it that week all the time. So it took me years to figure out that, this is a reoccurring problem. And you know how I found it? By looking at my journals and saying, where's all my losses at? It's the first week of the month. Where? Thursday and Friday around non-farm payroll. Whoa. You know what happened? When I stopped taking those trades and those trading days as opportunities, right away, my win-loss improved immediately. Well, is that any surprise? No, it shouldn't be a surprise. But I was completely flabbergasted because I had no expectation of seeing such a turnaround in my results. But I targeted a weakness. See, you're trying to avoid your personal weaknesses, and you're never going to improve until you identify them. In this mentorship, this is why you don't trade with live funds. You need to find where your problems are, and don't be afraid to observe what they are. Because if you don't recognize them right now, they're going to be hidden under the surface. And then when you start trading with live funds, probably way before you should have, they're going to hurt you, and you're not going to understand what's happening. And you're going to look to blame something outside yourself when the problem is within you. The best trader in the world that you're ever going to be resides inside of you. But it's hidden under layers of bad habits, toxic thinking, and just poor organization. Period. And all of you that just came in, and some of you from the first group that are still struggling, I swear, if you just think about what I'm teaching tonight, dig into the things I'm talking about, you're going to see and you'll unearth those things that's holding you back. And some of you are probably shaking your head thinking, yeah, I already know what this is. This makes a lot of sense. I can see where I'm messing up. Now, this is just one spot of the year that repeats every single month for me. There are times like in December and the month of January, I don't do trading because of similar things. That's where I lost money, a lot of it. And I learned to trust the fact that by waiting, it gives me traction. It gives me peace of mind. And when I was doing the first couple of years of mentorship, it was really something it was a bothersome thing for me because I knew people coming in, you don't have the experience that I have. You don't have the personality or perspective that I hold over price action. You want to, but you don't want to do the things I'm teaching you to do to get to where I'm at. And most people don't listen. Okay. And the first month of the year, when I was opening up mentorship early on, it was problematic. I had so many people quit that month because it was me saying, we're waiting. It sounds like this guy doesn't know what he's talking about. But now you understand. And this is the reason why I held back enrollment on the last 2 enrollments until January 27th. Because I don't want to endure all of the neophyte arguments about why I should be doing what I should be doing, at a higher pace when I know why I'm doing what I'm doing and they don't know. So to save all that and really give you the advantages that the other groups didn't have, I've learned from my lessons by letting people in early at the beginning of the month or the year. It was problematic because you aren't going to see what you're expecting to see. But because I delayed that, you had a small period of adjustment, and then now here we are in February, and then boom, it came off like gangbusters. Perfect. Not a lot of pips. I'm not saying it's a lot, but just perfect scenario. And I want you to grow in knowing that this is the way we do things around here. We want to focus on when it's really likely to work out in our favor and identify when it's not. And when it's not, we sit on our hands and we don't worry about sitting on our hands. We don't think about, what if I miss a move? You're going to miss moves. But there needs to be a very adult perspective, a responsible perspective by you as a student. Because I'm giving you the best advantages in this when you think I'm holding you back. And it's just your infancy that's telling you that. It's an internal dialogue that you're having, and maybe you've had already before we had this week open up. And now you see the difference. Okay? You'll grow out of it. It's like anything else. But it's going to take time working out these bad habits, and don't be fearful. But don't challenge yourself by trading in the environments I tell you not to. Just identify them as molasses pits. You don't want to be out there. You're going to get stuck in the mud or hurt. So just avoid them. So we have sell-side liquidity pool after breaker. It trades down into 2 pools of liquidity from these lows and this low here, and failed to get down below here. We consolidated, traded back up to a bearish order block in a small little gap right in here. Okay, look at that. Small little gap. So if we were short, I'm not saying I am or I would have been, but again, just like I mentioned on the other instance where there was a small little imbalance, that right there is something I would watch and see, do we have sensitivity there? If it does react like that, then I know I'm on side. Or if the is still bearish, I'm going to trust my logic. And I'm expecting it to trade below this low here. That's what I'm thinking going forward into, like I said, tomorrow. Does it need to go a little bit higher and take out a short-term high for a stop run? Maybe. I don't know. But because I don't know and I don't trust the weekly performance from now until Friday's close because of non-farm payroll, I'm telling you with all honesty, I don't know. But if it guns in my head, I'm thinking it's going to be a big range down. 15-minute time frame. If you're not ready, pause your video. All right, small little imbalance. You can see the reaction here. Breaker here. So we have a fair value gap and breaker. Right in here, fair value gap. Optimal trade entry as well. Sells off, fair value gap, consequent encroachment, trades lower, back to fair value gap, which is also institutional order flow entry drill. And then reaches into another sell side liquidity pool, bullish order block here, back to the fair value gap. Optimal trade entries in here that are layered. So in best case scenario, this should remain heavy out through Asia, then consolidate going into London, quiet through London, then a lot of excitement in the New York session. And finally, 5-minute chart. If you're not ready, pause your video. All right, so we have fair value gap in here before New York midnight on February 3rd. Runs up, buy side liquidity taken out, back to the fair value gap, optimal trade entry here, and inside of the breaker, London open kill zone, sells off, fair value gap trades back up into London open kill zone, optimal trade entry, consequent encroachment, midpoint of the gap, sells off there, bearish order block, hits it here with fair value gap, consequent encroachment there, then sells off right into 7 o'clock in the morning New York time. Again, what do we expect at that time of day on this week? Potential market reversal profile. Well, we have a run, break in market structure, trades back down in, rally, fair value gap, consequent encroachment, runs up, retracement, order block, rallies, back into the fair value gap, big beefy candle, that's your bearish order block, trades into it here. Consolidation, works the fair value gap level here. See that? Find support and resistance ideas that give you these types of little moves here. Now, it's not a lot of pips, but look at their sensitivity because we're using the imbalance, extending that out in time. I've already counseled you to have a chart in your collection of your charting platform that just uses fair value gaps and extending them in time. And you'll see support and resistance ideas that you never noticed before. And you don't ever need to draw another diagonal support resistance level. Okay? They're dumb. They're stupid. These are the levels you want to be watching. This is what the banks are watching. They're not looking at diagonal support and resistance. I swear to you, they're not doing that. They're not. And I know it's hard to believe, but that's the truth. Okay. So we're looking for lower prices. Nice little reaction here off the rejection block. I failed to mention that. But that was the run on the sell side liquidity here. And then we trade one more time below the rejection block. And then we have that pump up into the fair value gap, which is characteristic of the Wednesday of non-farm payroll week. So hopefully you found this insightful, and I'll catch up with you tomorrow in our daily log entry for the ICT mentorship. Until then, be safe.